All right. Happy Sunday, everyone. Happy Sunday. My name is Clinton, and I'd like to welcome you to my YouTube channel. We're about to kick off this series of lessons, Futures Trading 101. Futures Trading 101. I'm excited about this. If this is your first time here, this is my YouTube page, Blackwing Capital. Blackwing Trading, as it was, Blackwing Trading, where this is a live stream options and futures trading channel. And so what I do is I go live every Friday and I show you my trades, good, bad, and ugly, so you can get a real picture of what trading is, so you can see that, hey, this is something that's not attainable. This is something that you can do once you learn the principles and the concepts. And then you can start to do this yourself to earn money in the markets. And so that's what I do on my channel. Another thing I do on this channel is what I'm doing right now is teaching classes, and I'm going to go live teaching classes on Sundays, just about those principles about trading and things like that I can't go into while I'm actually trading on Fridays when I'm live. I'm going to do those things on Sunday. So we can talk about things. You can ask me questions. I can answer those questions. And then you can go back and look at it and say, okay, yeah, he talked about that. Okay, now I'm trading. Let me see how this plays out in my actual trading. And so that is why I wanted to start at these series of classes, Futures Trading 101. So this is going to be an 8-part series, of Futures Trading 101, where it's going to be once a week. I'm going to do this every Sunday at 6 p.m. and I'm going to cover like one concept. It's going to take somewhere between 30 and 45 minutes of your time. I do respect your time. I do know that this is Fun Day Sunday, and so you might be doing a bunch of different things. So I don't want you on here. I won't be trying to take up a lot of your time anyway. Just want to give me about 30 to 45 minutes of your time. We'll go over these concepts. And then if you miss it, like we miss a couple of these classes, you can always jump on my YouTube page. I do have a playlist already created that says Futures Trading 101, where you can jump on and you can look at these previous lessons. So I do see that we got a couple of people on, but if you don't mind, just get into the chat and let me know who you are so I can see who is on this live stream on today. If you don't mind, just get into the chat and then let me know that you're on. And then also, I'm building a new YouTube channel, so please subscribe if you haven't already done it, and like and hit that notification bell so you know that when I go live, you'll get that notification. You won't miss any of my content. So if you don't mind, just go ahead and jump into that chat and just say, hey, I'm here. So-and-so is on here now, just to let me know that you're here. All right. A couple of things I want to do, want to talk about before we get started. And I hope everybody can hear me now. Couple of things I want to do is just set some rules for the road for the class. So put out your questions in the chat. I prefer that you put them in the chat, but you can put them in the comments too. But I prefer that you put it in the chat. If you're on the live, you can put them in the chat. But if you have a question afterwards, maybe it was something that came up that you didn't think about, you can go to this. Maybe you can go to on a different day. Hey, Butlers, I see you. Mary Ellen and Chance and family. I see you, Chance. Thank you for jumping on here, sir. Appreciate you. Heard a lot about you from your mom. All right. So if you have a question that's after this, you can go into the comments and then you can put the question in your comments. And what I'll do, I get a notification that you made a comment on the channel. And then I'll go answer your question in the comments if you have a question after this. So that's the way I would like to do it. If you got a question real time right now, just go ahead into the chat, put that into the chat, and then I'll answer in between. I'm going to be showing a PowerPoint presentation. So like if I'm talking through one slide, I'll go through what I'm talking about. And then if I see your question, I answer that question, and I answer it for everybody so everybody can hear, because some people may not want to ask a question, but they still have that question. So I answer it for everybody, and then I'll move on to the next slide. Also, another thing I'm going to do, I'm going to pin in the comments. So like if you have another question and you don't want to do it in the comments, but you can send me an email. So I'm going to put my email in the comments and pin that so you can see it at the top. And you can send me a question and I'll be happy to answer it when I see that email. I do check my email for this channel a lot, and then I'll answer your question and then send you an answer back to the greatest of my ability. Matter of fact, if you ask me a question and I don't know the answer, that's what I probably do. I'll say, hey, why don't you put your email or send me an email of your question, or put your email in the you can send me. You can send me an email once I put it in the chat. That way you don't have your email out for everybody to send you an email. But you can send me an email, and then I'll answer your question back in email if you want to do it like that, if I don't have an answer for you. All right, yeah, I got a couple of people on. So that's all I have for the rules of the road. But if you have any questions, please don't be shy. This is meant to be interaction, and I meant for this to be for interaction. And so so I appreciate if you ask any questions. This is what it's for. So let me go ahead and cut to the slides right now so we can go ahead and get into the lesson. All right. Hopefully, everybody, you see a slide right now that says episode 1, what are futures contracts? That should be up where you can see it now. And this is what we're going to be talking about here. What are futures contracts? When I thought about what's the starting point for trading futures, instead of just throwing you into futures and say, OK, trade this or get a broker and put this money in your account and do this. It's good to start you off from the beginning. Like, OK, what are you trading? What are you doing? What even is a futures contract? It's good to start there so you know what you're doing and having that base of knowledge. And so I found it fit to start right there at what is a futures contract, so you know what it is from the beginning. You know, the story is told about Vince Lombardi. He was a very famous football player with the Green Bay Packers in the 60s, 50s and 60s. And even though men have been playing football all their life, he would start off every training camp, hold up a football and say, this is a football. And so that's what I'm doing right now. This is what a futures contract is. All right, Joey, I see you. Thank you for getting on, brother. All right, so what is a futures contract? Futures contract is a financial instrument. You know, think about a financial instrument like, like a bond or a stock or something like that. This is a different financial instrument that allows people, participants, you and I, big companies, corporations, we're participants, to offset or assume risks of a price change in an asset over time. If you're offsetting, you're doing what you call hedging, and we're going to talk about that a little bit more in this class. And then if you're assuming the risk, what you're doing is speculating, and we're going to talk about that in this class. But either you're offsetting or you're assuming the risk in a price change in an asset or commodity over time. And so it's a legal contract, and it's agreement to buy or sell an asset. That's what futures contract. So I think about even like you're buying your house, you know, in a sense, when you buy a house, that's kind of like a futures contract, because when we buy a house, what do? We put earnest money down. You know, like when I bought my house, I had to put an earnest money down, and then you closed in 30 days while the title company was going through, you know, running titles and make sure everything was clean, everything was good to go. And then after 30 days, you took delivery of that house at the price that you agreed to, you know, however much your house costs. That's really, in essence, what a futures contract is. So everybody who's bought a house, if you bought a house, a futures contract is just like that. So it's a legal agreement to buy or sell an asset. And the key thing about a futures contract is at a set price on a future date. And so that's hence why they call the name futures, is at a set price and is on a future date. And so I brought up the example of a house. You know, that's a futures contract in a sense, where you buy a house. It's really a real estate contract, but it's the same principles of a futures contract. But you have a set price, and then you have a set date that you're going to do it. And futures contracts, we're going to talk about that in a little bit in this class, but in classes to come. They offer them at set times. Those contracts expire at set times because future contracts are standardized. And that's the next thing that we see on this slide, that they're standardized and they're traded on futures exchanges. And so it would be really hard to trade futures if everybody had a different standard of what a future contract was, right? It's like if you buy a house, like in the state of Texas where I'm at, there's a standard contract, a way that you buy a house. You know, there's a standard contract that you use when you buy a house. And, you know, there's standard interest rates and things like that. And so everybody is on the same sheet of music. Well, that's really important in the futures market because the world is interconnected. And so, you know, I may be in another country, you know, buying a particular thing, And we all need to be able to talk the same when we're entering into these futures contracts. And so, they're standardized and they're traded on futures exchanges. We're going to talk about exchanges a little bit down the road, I believe in episode 3. But exchanges, think about it as the marketplace where all the buying and selling takes place. And that's what an exchange is. And they are standard exchanges that sell certain futures contracts. And I'll talk about that, like I said, in a couple of episodes. I believe it's episode 3. But that's the basics. That's what a futures contract is. If you remember, it's a financial instrument, and it allows you to either offset, which is hedging, or allows you to assume the change in risk, which is speculation, and it's a legal contract, buying asset, selling asset over time. All right, so let's look at a little bit more. What can you trade futures on? What are the things you can trade futures on? Well, there's a lot of things you can trade futures on. You have your agricultural futures, things like corn and soybeans and coffee and wheat, where all these things are commodities. These are physical assets, things that you think about a commodity. You hear me use that word. That's something that you can touch, taste, feel, those type of things. Those are commodities. Now I'm gonna date myself a little bit here. One of my favorite movies was Trading Places with Eddie Murphy and Dan Aykroyd. And if you remember in Trading Places, if you remember that, have you ever seen that movie? At the end, when Dan Aykroyd and Eddie Murphy they got together, what they did is they got the crop report on oranges futures. And so they saw that, okay, the orange crop is going to be a little bit different than what everybody speculated. And so they actually were exchanging and selling futures in that movie. And so that's what happened. If you saw that movie now, I'm dating myself because it came out in the 80s, but even so, they were exchanging futures in the movie Trading Places. And so the oranges in Trading Places is a physical commodity, and you can do physical commodities for agriculture in futures: corn, soybeans, coffee, wheat. You can do things like natural gas and oil. Those are called energy futures. Natural gas, liquefied natural gas is really big right now. Crude oil, oil gives us gas, petroleum products, plastics and all those things. And so, oil is very important. We do understand about the price of oil. So people do futures contracts on oil. You can do futures contracts on, the S&P 500, which is an index. I trade futures on the S&P 500, the index of the top 500 large cap companies. And it's an indicator of what the market is. You can do it on the NASDAQ, which is the tech companies. You can do it on the Russell 2000, which is the small cap companies. Oh, sorry about that. Hit the button. Let me go back. So you can do futures on the indexes. You can even do futures on crypto. People don't know that, but you can do futures on crypto now. And these are the assets that you can do futures on crypto, XRP or Ripple, which is the name of that. Ethereum, Solana, and Bitcoin. You can do futures on those crypto assets. And I would expect that as crypto continues to grow and it gets more normalized as a financial asset in markets, that you'll probably see more futures and more standardized futures contracts with crypto. And so that's something that you can do right now in crypto futures. And you can do even treasury bonds. And so they sell futures on, treasury bonds. So you look at the U.S. bonds, a 10-year or a 30-year bond or a 20-year bond. You can do futures contracts even on those bonds. And so you can do futures on so many different things. You can do them on commodities. You can do them on precious metals. I don't have that up here, but, if you want to do futures on gold or platinum or silver, you can do futures on those precious metals that people are using, things like that people produce or we get out of the ground so that other producers can use to do things like put in electronics and all that different stuff. And so you can do futures on that. You can do it on currencies. You can do it on indices, interest rates, and more. And so what I'm getting at here is that the futures market is very robust. It's very robust. And so there are many different things that you can trade futures on. All right. So I mentioned some words a couple of slides back. I said you can offset a price, and that's called hedging. And you can assume a risk, that's called speculation. And so that answers the question, why do people trade futures? And so let's look at that. Why do people trade futures? Well, first primary reason people trade futures is for hedging. As a matter of fact, the futures market, when it was created, it was more so leaned towards hedging. And so you might be like, okay, what is hedging and what are hedgers? Okay, so hedgers are primary participants in the futures market. And it's an individual. Here's what you need to think about. You need to think about an individual or a firm that buys or sells a physical commodity. So, think about a big firm that, sells, for instance, if you think about farmers, we're going to be talking about farmers today. So I'll bring that up. So think about a farmer who he grows wheat. That's his product. And so he might be hedging to protect his offset a price or protect a price change in the market because he has a certain product that he's producing. And so we can think about wheat. But hedgers, like I say, I want you to think about producers, wholesalers, retailers, and manufacturers. And these are people who are all affected by changes in prices of a commodity, all right? Changes in prices. If I'm a wheat farmer and I'm producing, thousands of bushels of wheat, I'm going to be affected by price changes in wheat. What if I produce these thousands of bushels of wheat and it costs me a set amount of dollars to produce a certain amount of bushels when I go take into account my fuel and my labor costs and all those things? But then what happens if the price of wheat falls and I can only sell it for, a certain price when it's time to bring the harvest? I might lose money. And so think about a farmer. A farmer might spend 2, 3, 4, 5 months bringing a harvest. And then once they reap that harvest and they take it to the market, in price changes, if the price changes, they may, have a loss of something that they put 4, 5, 6 months into growing something, and they may actually incur a loss when selling it because the price is dropping. So futures help people offset, hedgers offset that price change. And so I'm going to show you an example of that. But that's why people hedgers use futures to offset the price. And it's buying and selling futures. It protects against the price swings. And so let's make that a little bit real. So let me show you some things here. All right. So one of the primary wheat futures, I brought up wheat, is a Chicago SRW wheat futures contracts. And so this is off the CME Group, which is one of the major exchanges for agricultural futures. This tells you, if you go on this website, it tells you all the specifications for a futures contract. And so I told you futures was standardized, right? And so anybody can trade futures, and they know, this, for instance, this page, and we'll talk about this. You don't have to sweat about this because we're going to go through this in detail in later lessons. But it tells you one futures contract here for wheat. Now, this is for one thing for wheat is 5,000 bushels. So one futures contract is going to be 5,000 bushels. And it tells you right here, that's approximately 136 metric tons. And so you can get an idea of what this is. 1 metric ton equals to 1,000 kilograms. And that's about 2,200 pounds. And so you can get an idea that, okay, in one futures contract, we're talking about 5,000 bushels, which is 136 metric tons, 1 metric ton being 220 pounds of 2,200 pounds of wheat. So now we're talking about, you multiply that by 136, we're talking about almost 300,000 pounds of wheat. So you got an idea of how these futures contracts work. Here it tells you price quotation. It tells you how they're priced. That's very important. We're going to talk about that a little bit in this lesson, but then we're going to show it in some other lessons because the futures move at a certain way on a chart, and you got to know what those price movements mean. And then here it tells you like the minimum price fluctuations. And so for futures, the minimum fluctuation that it can move is 1/4 of 1 cent, which is 0.0025 per bushel. But it tells you here that equals to $12.50. And so think about it. If a price of 1 bushel of wheat moves 1/4 of a cent, not even a whole penny, but 1/4 of a penny. If it moves up, that's 1/4 of a cent. That's $12.50. If it moves down, that's $12.50. So that's 1/4 of a cent. So if the price of wheat moves 1 cent, that means that's $50. $50 for a 1 cent price move in the price of a bushel of wheat. That's something that is going to come up here in this lesson, and I'm going to show you. So here's the example that I'm using. So we can, I'm a visual learner, so we can put some more visualization to this. So during spring growing season, there's a wheat farmer. He's concerned about the volatile prices of wheat in the markets. So if the prices drop, he could possibly sell his crop at a loss. All right. Now let's mention that. He decides to hedge exposure by selling a wheat futures contract in the spring. And so in the spring, he's looking to say, OK, I'm looking at the prices. I think the prices may fall. I want to protect myself. And so what I'm going to do is I'm going to sell a futures contract. Now, in contracts, you can sell them or you can buy them. And you hear the term, you can go long or you can go short. And so when you're selling a futures contract, it's called going short. So that means that you're selling it high, but you want the price to fall and you're going to buy it back. Normally, when you're trading, you buy something, you buy it low, and then you sell it high, right? So like if I have something, anything that's even not related to the market, think about the real estate. You bought your house at a certain price and you want to sell your house later in the future for a greater price. That's the normally what we call going long, where you buy low and you sell high. But also you can take advantage of price drops to where if you buy it high and you think the price is going to drop, you can buy it high. You can sell it high and then you can buy it back low. And so this is what this farmer does. Since he thinks the price is going to go down, he's going to sell a futures contract high, but then he thinks the price is going to drop. So that means that the price of wheat is going to drop and he's going to buy it back lower. So that's why he's selling a wheat futures contract. So in the fall, if the price of wheat drops, he loses money when selling in the open market, but the profit of his futures contract would gain with the decrease in price. So conversely, if wheat prices rises, he would gain up on selling in the open market, but he might possibly lose on his futures contract due to the price increase. So let's look at this a little bit further. All right, so here's basically graphically what I was talking about. So in the spring, the prices are higher, but he thinks they're going to be lower in the fall. So he thinks it's going to go down. So, there's a balance between cash and how much you can get for it and then the futures contract, right? So in the spring, he can't sell his wheat. Why? Because it actually hasn't come out the ground yet. He's growing it, right? He's a farmer. So he knows that the harvest, though, is going to be in the fall. So what he would do if the price drops, he's going to lose cash on the price of wheat, because as a farmer, his set price is, okay, this is how much my labor cost is. This is how much my fuel. This is how much water is. This is how much fertilizer. He has that down to a science of how much it costs for him to buy to produce a bushel of wheat. And so that goes down. He's going to lose money in cash, but the futures contract is going to go up. And so it offsets how much he would lose in cash. All right, so let's look at that even a little bit closer, because I want to put some real numbers on this. All right, so this chart that you see right here is the actual wheat futures chart that I have, which is the yearly wheat futures chart. I just put this in here today because I want to put some real numbers to this. So let's look at if we were actually trading this. Okay, so on February the 3rd, we call that the spring, or we may call that the winter or the spring, but that's the beginning of the growing season. So this farmer said, all right, here's what I'm going to do. He's looking and he says that the price of wheat right now, the price of wheat per bushel is 605 cents. Now, the chart is in cents. So it's 605 cents and it's actually 605.4, but I'm going to round just to make the numbers nice. It's 605 cents per bushel, or $6.05 per bushel. So now the farmer, using this example, he likes that price. Here's why he likes that price. He likes that price because when he calculates his labor costs, fertilizer, equipment, fuel, all those things, in his mind, that $605 per bushel gives him all his costs plus a 20% margin. So he's able to pay everybody. He's able to do everything, all his equipment and everything, and he makes a 20% profit. So he likes that number. But he says, you know what? I think the price of wheat is going to fall. So I'm going to sell a futures contract to help offset that and help me if the price drops. Okay, so this was the actual price of wheat on February 3rd. And this is right before Trump was inaugurated. It was $6.05 per bushel. Now, this farmer was right. The price of wheat did fall. But if we look at it, when we look at this chart here, the price of wheat went up a little bit and then it fell. And then it went up a little bit again, then it fell, and then it kind of went sideways. And now we come to the point of where we are right now, and where I'm on the chart over here on the right-hand side. This is July the 3rd. So on July the 3rd, the price of wheat is 556 cents or $5.56 per bushel. So the price of wheat actually fell the way that he thought it was going to fall. But let's see how the farmer plays out, because he's smart. He bought a futures contract. So price of wheat is falling 49 cents per bushel. And remember, the futures contract is talking about 5,000 bushels. So we're talking about big numbers, right? So for 5,000 bushels, the price difference, if he sold it, his wheat at $6.05, he will make $30,250 on those 5,000 bushels of wheat. That's a lot of money, right? So if he sells those 5,000, and think about it, maybe he's a big wheat farmer. Maybe he's selling 10,000 bushels. Maybe he's selling 20,000 or even 50,000 bushels. So you can see, the more bushels that he sells, this is how the price changes. But we're just going to take 5,000 bushels so we can equate it to the futures contract. So if he sells it at $6.05, remember that's his 20% margin after he pays everybody and everything else, he would sell it and make $30,000 and $30,250, and that would make him pay everything, and then he would have 20% profit on that. But the price of wheat has fallen like he thought, so it's actually $5.56. So 5,000 bushels times $5.56, that's equal to $27,800. So he actually lost $24.50 per 5,000 bushels. So you can see how that can add up. If he's doing 10,000 bushels, now he's losing, almost $5,000. And every 5,000 bushels that he does, if he's doing 100,000 bushels, you can see that, he's losing a lot more than that. You multiply 2550 by 20. So you can see that, this price drop actually has affected him a lot. But I said he was smart, right? So he sold one futures contract. Now let's just look at this. As I mentioned earlier, $50 per 1 cent price change. That's how much these futures contracts are worth. So for every 1 cent that the price of wheat changes is worth $50. That's up or down. And he sold a contract, so he wants the price to go down to balance that out. So now let's just look at this. 605 cents minus 556. We still got the same 49 cents, right? But so that's 49 cents times $50, because the price change is $50 per 1 cent. So he's actually making $2,450. So the wheat farmer is actually breaking even from when he sold the contract. So that means that he's still going to make his futures. He's still going to make his 20% margin, even though the price of wheat fell down. Even though it fell down, if he sold it right now, July the 3rd, at $5.56 per barrel, he would lose in the open market by selling it. He's going to lose a little bit, but then when he buys back his futures contract, he's going to make up that exact money and he's going to be break even. So that's the power of futures, and that's the power of hedging. That's why producers and people do this, because they want to balance that out, and they want to balance out their costs. And hopefully that makes sense. Anybody have any questions about that? I'm just looking at the chat to see if anybody have any questions. I hope that makes sense to you, but this is why people sell futures. This is why hedgers, get into the futures market, because they want to be able to protect, what they're buying and producing and things like that. All right. So nobody have any questions about that. I'm gonna move on to the next thing. So first we have hedgers. They're trying to protect, their costs. Then we have what we call speculators. So speculators are a little bit different. Let's see what they do. So speculators, they're also primary participants, in the futures market. But instead of being that person who's actually farming and trying to protect their costs and their margin and all that stuff, they're a person like you and I, and we just follow wheat, in the futures market, and we like to speculate. So maybe we said the same thing that Farmer Jim said. We said, all right, okay, hey, I think the price of wheat is going to reduce in the harvest time. And so we're sitting at February 3rd, the same way that he is, and he's doing it for one region for hedging, but we're doing it for another reason, which is speculation. And so speculators is an individual or a firm that accepts risk to make a profit. So a speculator can be an individual trader, that's you and I. They can be a proprietary trading firm. So somebody actually has a firm and they specialize in futures trading. They can be portfolio managers. They can be hedge funds, and they can be market makers. And so a lot of people trade in the futures market because, they're managing a portfolio, or there's a hedge fund that you have your 401k is invested in or something like that. And they're using futures and the speculation in futures to maintain value actually in your 401k or your portfolio. And so you have traders who are doing that, who specialize in futures. So speculators, they profit from price movements, right? They profit from price movements, whether it's up or down. As long as they have the direction right, they're making money. Now, I mentioned this a little bit earlier, but speculators, this is what they do. They either buy low or sell high, and that's called a long position. So like I mentioned, like your house, you buy your house at one price, and when you sell it, maybe 10 years down the road, you want to sell it at a higher price. So you bought low and you sold high. But you can also sell high and buy low, and that's called going short. And this is an example that we're using where we see something that's at a higher price, but we think the price is going to drop. So, you can sell high and then you buy low. So you're doing it in reverse. And this is one of the beauties of the futures market. You can make money if something is going up, and you can make money if something is going down, right? And so, we really like that. So let's look at the speculator. So we're looking at the same prices, February 3rd, we still got the same thing, $6.05 per bushel. July the 3rd, same thing, $5.56 per bushel. So the price of wheat is still falling that same 59 cents. So now here I am, I'm Clinton, and I'm the wheat futures trader. Now, I sold 3 futures contracts. So Farmer Jim, now he only sold 1 futures contract, but I'm a speculator, and so I'm trying to make money. So I'm going to sell 3 futures contracts. And so I'm selling 3 futures contracts on February 3rd, and the price change is still the same thing. Per 1 cent, you make $50 per 1 cent. And so it's 49 cents. But now I got 3 contracts instead of 1. So that's 49 times that $50, but now 3 contracts. And so now I am up $7,350 on those 3 wheat futures contracts that I sold. And that's how speculation works. And so, I'm saying, all right, I think the price of wheat is going to change or go up or go down. So I say it's going to go down just like Farmer Jim did. But I thought I bought 3 contracts. And so I'm going to make $2,450 per contract and multiply that by 3. That's $7,350. Now, if you're a speculator, that's one other thing you got to think about. So speculators like you and I in the markets, we go through a broker. And we're not trying to take delivery, or sell those bushels of wheat like that farmer is, right? That farmer is actually got the physical commodity. He's pulling it out of the ground. He's wrapping it up and he's measuring how much it weighs. So he makes sure that he knows that, he has a certain amount of bushels. And so he actually has a physical product. But for us, if we're trading in the market, we don't want to take delivery on it, but we do want to take advantage of the price change. And so to be able to do that in the markets, you have to go through your broker. Now, what your broker is going to say is, okay, you need to have this amount of money to be able to buy or sell a futures contract. So for this example, for my broker is Tasty Trade. They require you to have $2,557.50, and that's called margin. We're going to talk about that a little bit later, in my account to buy or sell 1 futures contract overnight. So, to be able to do this, what we just saw, you actually have to be able to hold that contract over multiple days. It's a swing trade. And so your broker is going to say, okay, for you to be able to hold this contract, you got to have this amount of money. It's margin because it's actually not the full value of a futures contract. And let's go back to our previous example so I can show you that again. Remember, 1 futures contract is 5,000 bushels. And if we were at like the previous price, the first price, which is $6.05, one futures contract, 5,000 bushels, that actually equals to $30,250. So that 1 futures contract is actually worth $30,250. But your broker will say, okay, but you can trade it with $2,557. That's how margin works. And so you're not putting up the full amount to actually control these contracts. And that's the beauty of the futures market, is that it's what we call leverage. It's leverage. That means that you don't have to have all the money to be able to trade and take advantage of these price changes. They won't say, okay, you need to have the full $30,000 to trade this contract. They're going to say, okay, in this case, you need $2,557 to be able to trade this in the market. And so let's think about that. If you had $2,557.50, and that's for one contract, so Clinton would need, that's me, $7,672.50 to trade 3-week futures contracts. So think about that. If I had $8,000 in my futures account, $8,000, then I can buy 3 futures contracts. I could have actually took this trade, and if I sold it right now on July the 3rd, which was Thursday, if I would have sold that, I would have made the same $7,350. And so I would have almost doubled my money in 5 months. Just think about that. I took $7,600 to trade these contracts, and when I sold it at this price, I would have made $7,350. So almost literally doubling your money at that point. So if you only had, $8,000 in your account at the end of this 5 months, you'd have been at almost $16,000 in your account. Would have doubled your money. And, in the stock market and things like that, this is the beauty of the futures market. And this is why people love futures and things like this, to the leverage, because, if you go to your financial advisor or something like that, and they're going to put you in a portfolio, they're not going to tell you that you're going to double your money in 5 months. Matter of fact, they're going to quote to you like 8 to 10% or something like that, or depending on what your risk level is, it may be something lower than that. So they're going to say, hey, put your money here. We're going to grow it at a nice, steady 6 to 8%. But if you're trading futures, you can take that $8,000, buy 3 futures contract. And if the price works like this, you're going to double that money. Now, the other side of that is true, right? So I don't want to just paint the rosy picture, but the other side of that is true. If the price would have went up and would have been up 49 cents, then you'd have been down $7,000 in that. So hopefully that makes sense to you. But this is the power of futures and speculation. Now, I want to show you another one with something that may be familiar, because we're talking about wheat. But let me show you another example of something that may be familiar, and that's crude oil. So crude oil is another thing that you can trade. So same thing. Now, this is the actual chart of the oil futures. So on February the 3rd, crude oil futures was trading at $69.55 per barrel. $69.55 per barrel. Now, why would a futures trader think that the price of oil is going down? Well, in real time, you remember when President Trump ran for office, he said, what he was saying was what? Drill, baby, drill, right? Well, what that means, and we translate this to economics, that means that he's going to have the United States produce more oil, pump more oil. So if they pump more oil, one of the standards of economics is if you have more supply, that means that your demand goes down and the price goes down. So if you have less supply, that means that the demand goes up and the price goes up. And so, savvy futures trader might say, okay, President Trump is here. He's inaugurated now. He said he was going to, lower the price of oil. He's going to pump more oil. So I know that means that's going to lower the price of oil. So I'm going to go short on some oil contracts. And that's what a savvy trader might say. All right. So they were trading at $69.55 per barrel. On May 3rd, oil got to May 8th, it got down to $58.34 per barrel. So, that's $11 price change in oil. That's pretty big. Now, I'm just going to talk about 2 scenarios here, but don't look at the July 3rd right now, but let's just look at this on May 8th. So if you enter into a futures contract on February 3rd, you could have sold it on May 8th for $58.34 per barrel, right? So price change $11. So let's just look at this. So the price change in oil is $10 per 1 cent price change in oil, right? So when the price of oil changes 1 cent, that futures contract is that changes $10 because the standard oil contract is like 10,000 barrels, right? So And if we do the multiplication, the price change by $11.21 times 100 times, because I did $11, but we want to look at actual cents. So that's times 100 times 10, $10. If I would have bought one futures contract and sold, I'd have made $11,210 on that one futures contract, on the difference in the price of oil from February 3rd to May 8th. So we're only talking about 3 months now, 3 months. Now, every broker, they're going to have a set amount that they're going to have a set amount of margin, just like they did in a wheat. They're going to have a set amount of margin that you need to trade oil, right? So my broker, Tasty Trade, they're going to say, okay, if you want to hold a futures contract overnight, you need to have $15,290.55 of margin. That's how much money you need to actually trade this oil contract. Now, the actual contract for oil is a lot more, right? Because I said, it's like standard futures contract for oil is like 10,000 barrels. But they say, okay, only thing you need is $15,000 in your account, right? I mean, that's a sizable amount of money, $15,000, but you only buy one, right? But just think about that. You had $15,000 in your account. Maybe you did this after you did your successful wheat trade. So you would have basically had a return of 73% on your investment if you would have sold it on May 8th. Think about that. You had $15,000, and in 3 months, you made $11,000 using that $15,000 for one contract. So your account would have went from $15,000 to almost $27,000 in 3 months. You made 73% on your return, right? I mean, you can't get that on changes in the future in the stock market. So you got to think about, this is why people love. Well, you can if you have enough shares and stuff like that. But this is why people love trading futures, because it's leverage, and over a short amount of time, you really can make a lot of money. But let's say Clinton got greedy. Maybe I thought it was going to go lower, but the price of oil changed, right? And so this is July the 3rd. July the 3rd, the closing price per barrel, this is Friday now, it was $66.50 per barrel. So I was holding. I sweated when it got way up to $78 a barrel, because listen, that's way above what I thought. And say I didn't sell it though. Maybe I said, okay, this is just temporary. I'm going to go ahead and hold it, and it's going to continue to fall. So on July the 3rd, if I held it to Friday and I say, you know what, I'm tired, I'm going to go ahead and sell it, I still would make money. Let's look at how much money I make. So it's fallen, instead of $11 per barrel on May the 8th, it's fell $3 per barrel by July the 3rd. So if I do the same multiplication, I get $3,050. That's how much money I would be making. So, with one oil contract, remember, I needed $15,000 to do that. I would have made $3,000 on that. So I still would have a 20% return on my money, which is still great. Like I said, it's still great. With the amount of money that I'm putting in at $15,000, if you take that to your financial advisor, he might get you something. If he's savvy, he might get you something good where you might make 8 or 10%, but that's going to be over a whole year. But here in now, the difference between February, which is the second month, and July, which is the 7th month, that's a 5-month time frame, right? 5 months, you'd have made 20% on your money. So you can see how the futures market is something that you might want to get into, because it helps you be able to really, to multiply your money if you're trading right. And, some of you may, I don't know, some of you may actually have this kind of money sitting in a 401k. You might have it sitting in a savings account or something like that. Think about if you learn this skill of futures trading, you can take that money and, over the course of a couple of months, you could literally double or even triple that money. And that's not some pie in the sky thing that I'm trying to sell you. I showed you real numbers. This is real numbers. This is an actual chart. If you would have had this amount of money, you could have made this if you'd have got in and out at these times that we were talking about. So this is something that's real. This is not something that's, every once in a blue moon, or, something that, may have happened only, some special circumstance. This is normal trading in the markets. And this is just 2 examples. This is wheat and oil that I showed you. And, I showed you on those previous slides that you can do it with wheat, oil, soybeans, all type of things that you can trade. Does anybody have any questions about that? I don't see anything in the chart. Hopefully everybody's understand what I'm talking about. This is the power of trading futures. right, so here's a couple of things. I'm going to move on. We're about 45 minutes now, so I do want to make sure I'm staying true to the time. All right, so there are other derivatives, what we call futures. I'm talking about futures, but you can trade options as well. I started out trading options. I still do trade options on my channel back and forth. So, options are a little bit different. There's some differences between the two. I just want to talk about it. So we have a thing called an obligation versus right. So in the futures contract, if you hold it to the end, you have an obligation to buy or sell at that expiration. So once it hits that expiration date that you have in that futures contract, you have to buy or sell at the price that you enter into that contract in. So on options, it's kind of like that, but it's a little bit different. If you're an options buyer, you have the right, but not the obligation to buy or sell at that particular point. But if you're an option seller, you have the obligation to buy or sell. So that's how option sellers are related to futures. Think about the costs. In futures, you got to have the margin costs. We talked about margin costs to buy or sell a contract. An intraday is controlled by the broker. Overnight margin is actually set by the exchanges. So those numbers that I quoted to you, I talked about, Tasty Trade says you got to have this much. That's actually set by the futures exchange where all the futures contracts are traded if you're going to hold it overnight. But if you're intraday, within one day, from the time the market opens to it closes, your broker has leeway about how much margin they're going to say you need to trade. Now, but the cost in options is, if you're options buyer, the most that you put into it, the cost is the premium payment. All options have a certain premium when you buy it. And so that's how much it costs to buy it, and that's per contract. And an option seller, if you're an option seller, the premium that it costs to buy it, they actually give you that money in your account. They credit you that, and you're trying to, take advantage of the decrease in price. So that's how the premium works on options. What about the risk? So here's the only thing that's very careful about. You have to be very careful about with futures. So futures can have what I call unlimited risk, and here's why. So if you remember the example that I talked about before, an actual futures contract for 1 bushel of wheat, at that $6.05 was actually worth $30,000. But your broker said you only needed $2,500 to in your account to be able to trade it, right? Well, what if the price of wheat would have shot way up? Say it shot up $1. Okay, if it shot up $1, you would put in $2,500 to be able to trade it. But if it shot up $1, you would have doubled that. You basically would have been down $5,000. So in a futures contract, you actually can lose more that you put into that contract. So you have to be careful about that with futures. But in one of my classes, we're going to talk about risk management. We're going to talk about risk management and how you control that. And then also the brokers, if you're a speculator, the brokers will actually have some rules in place and not let you go over a certain amount. So most brokers, if you're trading futures and they say, all right, you need $2,500 to trade a futures account. When you get to, $2,500 in loss because it's moved against you, they'll basically liquidate your position and say, okay, you can't trade this anymore, because they don't want you basically owing them $10,000 for that futures contract when you don't have it in your account. And that makes sense. Okay, so for options, if you're a buyer, the only thing you're risking is how much you paid in premium. If you're a seller, you can have unlimited risk as well. And also, if you're a seller, for instance, you might have to buy certain 100 shares at a certain price. And so now you got the price of buying those shares. And so you can have a lot more risk. And so that's how there's differences between options and futures. And we may talk about that a little bit later in some of the slides so you can compare the two. But, for futures, these are the rules for them, how it differs versus options. And so go ahead and close this out. A couple of key takeaways, things I want you to remember. They're contracts to buy, sell assets in the future. They're used for hedging and speculation. And if we're trading in the markets, most of us are speculators. We're not hedgers because we're not producing any of this stuff or taking delivery on any of this stuff. So we're speculators. And they're different from options due to obligation and structure, but they are something that are very closely related. So I hope you got something out of this. We're at about 51 minutes now, and I thank everybody who got on and your participation. And so, a couple of things I want to let you know about just to remind you of. That I still do go live every Friday and I go live at 8:15 a.m. I would love for you to get on so you can see this in action and trading in action. So I can't talk about this stuff while I'm actually trading because we're looking at the charts. But on Sundays, we're going to go over the concepts and the principles, and then you'll see it in action in trading. And it'll hopefully the trading will make a lot more sense to you when we go through these classes and you see these things and you see the principles that I'm talking about. You see me actually interacting and doing these things when I'm trading. And so this is episode 1, Future Trade 101. That's it. If you have any questions in the future, go ahead, put in those comments. I get that notification and then I will answer your question. I'm going to put my email in the comments so you can see that. And until we meet again, be blessed. Have a great Sunday. And thank you for jumping on again.